Folks, welcome back to the Taylor Tax Show, the podcast that helps highly paid, highly taxed, high profile, high net worth, and ultra high net worth taxpayers save a bunch on taxes. My name is Terrence Taylor. I'm the co-founder of Taylor Tax. I'm an enrolled agent and have my MBA. It's my partner, Big Al Donnell Jr. Say what's up, Big Al?
What's going on, everybody? I'm Big Al. I love my mama.
Big Al is also an enrolled agent and he has his MBA.
And
We put this tax tips series together today to help millionaires. So the title for this episode is Last Minute Tax Hacks for Millionaires. Picture this. You just got your W-2, which happened to one of our clients, and you realize that you've paid over $1 million already in taxes, but you haven't even filed your tax return yet. So between now and April 15th, can you actually save on taxes? Well, that's what Big Al and I spent some time digging into. And we want to share with you tips and then the top three things that you can do. So to make this as efficient as possible, I'm going to cover the first five as tips. So literally just sharing the tips with you. And then my partner in crime, Big Al Donnell Jr., or my partner in leveling the paying field, Big Al Donnell Jr., is going to take you through the last five, and he's going to highlight the top three as part of that last five. All right, folks. So let me get into it. So, Big Al, one of the first things that people can do, if you haven't already done so, is to maximize your IRA contribution. So the deadline is up to April 15th, 2025. That could save you an additional 7,000 or 8,000, which we know is not a lot when you already paid $1 million, but it might be part of what you start doing. There's also the backdoor Roth element, which could also add some additional savings to this particular tip. Tip number two, if you haven't already done so, contribute to a health savings account. The deadline, April 15th, 2025. So if you had a high deductible plan in 2024, you can still contribute up to 4,150 if you're single, or filing single, I should say, or up to 8,300 if you had a family HSA plan. And if you're 55 and over, you can add an additional 1,000. Tip number three, make a SEP IRA contribution if you're self-employed or you have a side business. The deadline is April 15th. Or if you file for an extension, you could actually have up till October 15th to do this. If you have 1099 income or a business, you could also retroactively contribute to your SEP IRA. So potentially up to 25% of your net earnings or a max of 69,000, which is not bad, Big Al. That's like
not at all.
6.9%. Yeah. Number four, you could fund a defined benefits pension plan. Sorry, let me skip number four. I want Big Al to handle that. Let me skip
Yeah.
number four. We'll come back to that. So the next thing you could do is the fourth thing you can do is you can take advantage of the 2024 Q4 estimated tax payment. And so if actually, Big Al, I just realized, let's not tell them this one because they would have had to have done it by January 15th. So
Okay.
we're going to skip that one, folks. So the next thing that you could do is you could deduct the prior year SALT tax, so the state and local taxes. If you're able to itemize your deduction and you haven't reached that 10,000 limit, that you can do. And then the next thing that you can do is well, Big, I think I may have covered five there. Let me
Yeah.
pause. I'm
Yep.
going to hand over to you.
I'll tell you this, and that was a quick synopsis, Terrence. What I would suggest first is, we're already in January, or we're actually already in February. So step number one, go ahead and file an extension to give you more time for us to work with you and to set everything up. That's step number one. I don't care how much money you made. Even if you think you can file on time, make sure that you file an extension. That gives us time to do our thing. Now, next is that if you're the type, or if you've made enough money to have paid over $1 million in taxes between federal, FICA, state, property, sales, etc., taxes, then what you need to do is, I'm pretty sure you're invested in some sort of asset, whether these assets are real estate assets, whether they're assets, business assets, things of that nature. So what you want to do is look and explore how you can harvest capital losses. All right. Because if you have capital gains income, it can only be offset by capital losses. So what we need to do is we need to look into your portfolio, have a conversation with your financial advisor and see if there's a strategy that we could harvest some of those losses in a retroactive manner. So that takes a little bit more detail. So just think about that consideration. Next, one thing that I don't think a lot of people consider is truly reviewing and optimizing your business deductions before filing. Of course, you're looking at this thing and say, hey, I only spend business expenses on my business card, et cetera. But with a bit more scrutiny and reference to the tax code, there are so many things that I've seen clients overlook with deducting on their business, and so many other areas that money is just kind of staying on the table. You're not getting all the money off the table that you could get off as an actual tax write-off. And by doing so, these are large, very large things that you could write off. Now, which brings me to my next point, which is a defined benefit plan. Hear me, you get to a point where, or hopefully the goal is to get to a point where you're not needing 100% or even 50% of your income in order to operate. With that being said, there's large contributions that you can make to a certain defined benefit plans. And these defined benefit plans can be contributed to for the previous year all the way up to September 15th of the current year, because it's a qualified retirement plan. And how that works is more so you get like 150% of your income could be donated, or not donated, contributed to this defined benefit plan, defined benefit pension plan. So imagine if you made, in order to have paid $1 million in taxes, you would have had to made, let's just say $2 million. All right. So now if you made $2 million and you set up the defined benefit pension plan in such a manner, you could potentially contribute up to $300,000 in the first year or in each year that you bring in that type of money. Now, mind you, a lot of this is you're going to need to have your own business. And there's ways that we could set these things up. If you have a regular job that's paying you $2 million, and then you set up a entity where you can pay yourself,
Like a
and
side hustle.
exactly a side hustle, a side hustle where you're paying yourself this, $300,000 or $400,000, which could be paid. Anyways, there's ways to set this thing up so that you could get that immediate write-off, which is huge. All right. I'd make sure to look into that. And then finally, I believe I skipped over the opportunity zones. Oh, let me get back to this $2 million. I know some people might look at this and say, hey, who's making just $2 million from a regular job? We see it. We have clients that do. And a lot of times that's in the form of stock options. All right. Once again, the last thing I mentioned before the defined benefit plans were about capital losses and harvesting these losses. There's ways that you could harvest passive activity losses, capital losses, and other losses in order to offset some of these gains. It's a matching game, but we can do it. And now finally, opportunity zones. Pretty sure you're aware that these opportunity zones actually expire in 2026. So let's just say if you were to purchase something now using a qualified opportunity fund and you were to invest in a qualified opportunity zone, it's a risk, because in order to get a lot of these tax benefits, you have to hold it for at least 5 years. However, with Trump being back in office now, regardless of how you feel about him on either side of the political aisle, is that there's a very large chance that that qualified opportunity zone might be extended. You'll just have to keep considering that. However, the people that were able to take the greatest advantage of it before were those that were able to jump in it as soon as he mentioned it in order to get this full 10-year qualification. So what we would suggest is making sure that you look into the process of creating a qualified opportunity fund now, identifying qualified opportunity zoned assets that you'd likely invest in, and you make these investments. A lot of these investments have requirements of a certain percentage of your purchase price being put into renovating it. But what does that do? That allows you to do a cost segregation study and break down bonus depreciation and Section 179 depreciation, which could be up to $1 million. So these are beautiful things that you can look into. Don't count yourself out since it's already February of 2025. There's a lot of things that could still happen that can benefit you or reduce your $1 million worth of taxes below. But remember, this is going to take some thinking outside the box, and this is going to take some aspect of risk. Make sure you know what your risk aversion is, and that you make this personal assessment of yourself. And you had to be bold to have made that $1 million or $2 million. You're going to have to be bold in saving that $1 million or $2 million and take quick, decisive action. All right, brother. Back.
Right, cool. Folks, there you have it. So those were 9 tips and The top three, we went into a lot of details to share with you what you can do. So for those who would like help, get in touch. You can email Big Al at taylortax.ai. So BIGAL at TAYLOREDTAX.ai, or Terrence, TERRENCE at taylortax.com. Also, check out Tax Strategist GPT on the OpenAI GPT store if you want to ask some questions and see what else may be possible for you. All right, folks. See you soon.
Cheers.